Okay, so let's talk about Azariadis and Smith. So remember that in this model we had lenders who had to decide whether to put the wages into storage and get a return of A, or use the rest and put it in deposits and get an amount RT plus 1. We need deposits to be at least as attractive in terms of return as storage. And then on the other side we had the entrepreneurs borrowing money. They borrow this amount at a rate R. So they borrow this, through a financial intermediary who met the depositors and the borrowers. And the borrowers would invest this borrowed amount into capital and get in the future the return of the MPK, the marginal product of capital. Now, the key thing to remember is that we need the interest rate on the deposits to be at least as much as the interest rate on the storage, the risk-free asset. And if things go well, if things are normal, then what we will end up seeing is that the interest rate will be equal to the marginal product of capital. So these people will be paying exactly, for their deposits, for their borrowing, they will be paying exactly what they get of the capital next period, the marginal product of capital, and this will be more attractive than investing in storage. So no people would be investing in storage. That means that all the money from the lenders will go into financing the borrowers. So there will be a really high investment, and old savings go to deposits. There's nothing that's stored, and all the deposits go into borrowers that then produce the capital. So in this case, the capital law of motion is just this one where this is greater than 0.5. So there's really high investment. But the important thing here to remember is that this can only happen at when there is low capital, because that means that this MPK is high and this interest rate is high. So it is good for lenders because they receive a higher interest rate than the safe asset. So that's why they invest in the borrowers. Now imagine the other case in which there is credit rationing. Well, this happens whenever we have that the interest rate gets really low for whatever reason, and it hits the threshold of A. So I think of this A as being like 0. You store your money and you get nothing because you just put it under your mattress. You get 0. Well, imagine that the actual interest rate hits that value. Well, in this case, there will be a positive amount of people that will store their money. These people will be like, the cheaters who, they're lenders, but they see that the marginal product of capital is greater than what they could get in the market. So, either investing in the positive or in the safe asset. So they want to cheat and become borrowers. So the only possibility you give them is to invest that borrowing in the safe asset in A. So they end up getting just that A, and this results in insufficient investment in the economy, because there's lenders that are not lending money to the borrowers because the return of doing so is so low. So what ends up happening is that the capital level, this is lower than remember that this is 0.5, so this is less than that. Now remember, this can only happen when capital levels are really high, and there's a really low MPK and even lower return on deposits. So there's going to be a point for when you're a high level of capital in which this thing kicks in, and the MPK goes down so much that you actually hit this point where the return of deposits is just equal to A, and you have credit rationing and low investment. How does it look like? Well, you have first, for low levels of capital, you can have the normal low motion, where the interest rate is greater than A. But then for high levels of capital, what you have is the credit rationing low motion, where this is lower, and the interest rate is exactly equal to A. Remember to think of A as, this is the return of just putting the money under the mattress, so I think of it as zero. So when you hit the zero lower bound of the interest rates, then you're screwed in this credit rationing. So a first case would be, imagine that we have two steady states, and for whatever reason, you're here in the good equilibrium, and then you become pessimistic, and you suddenly, think the interest rates are going to be so much lower, so you hit the credit rationing equilibrium, and then, you shift around, your investment goes down by a lot in the next periods, but then suddenly you return to be optimistic, and, things get better, but then you might fluctuate around here. So you're fluctuating between those 2 points if you start between here and here. But now imagine that that you start in the same point, but there is no steady state for the credit rationing. So imagine you become pessimistic, and then suddenly, you keep going pessimistic for a few periods, but at some point you're going to hit low levels of capital. So this low levels of capital, the MPK is so high that suddenly you're just going to become optimistic, and this interest rate is going to go up and be equal to the high levels of MPK. So people really want to lend to the borrowers because the return of the borrowers is really high at this beyond this level. So you're just going to move up to the Belarusian equilibrium, and you're just going to keep up going until you reach this point here. Same thing can happen if you're going up from below and there is no Belarusian steady state, so you keep going up and up and up, and at some point you're going to hit the limit because the MPK is so low that at this point you just, the MPK, you could be thinking of it as, just being so low that you hit the point where it's just equal to A, and then you hit, you just go down to the credit rationing equilibrium for a while. You might stay there and go here, or you might become optimistic again after a little bit. But the key point is that at some point your MPK, because the capital levels are so high, the MPK is going to be so low that it actually hits A, and you go down to the credit rationing. Now imagine that you have a positive productivity shock. Well, that's going to increase your wages, so both of these curves will go up. So now imagine you were in this Belarusian equilibrium, but then this goes up, so you start moving. This other curve has also gone up. So before you might not even have a steady state, but now you do because you're here. And now a positive technology shock, which should be good for you in general, well, in this case, it makes your capital, when you already had a high capital level, it makes your capital go up. And, this decreases the MPK just enough so that it hits the point where the interest rates become just the interest rate of the stores. Think of it like, the capital is so high, the return of capital, the MPK is so low that, it just hits zero at some point or something like that. And then you just go down to the credit rationing equilibrium. At this point, you might stay there, and you might converge to this equilibrium here with lower investment because of this original productivity shock. But along this movement, you're decreasing the amount of investment, so your MPK is growing up, and you still have that the interest rate in deposits is equal to the interest rate of the safe asset, the A. Well, in this case, this is going up. This used to be equal to R, but not anymore. Now is higher than R. So you just get that the MPK is higher than that, and you might converge to this point in which you stay in the credit rationing equilibrium forever because of a positive productivity shock.